Today we're going to be talking about the differences in APR versus APY when it comes to yield farming and cryptocurrency in the decentralized space. Ladies and gentlemen, if you love earning passive income and you love cryptocurrency, do me a favor, two things. Smash that like button, go down in the description, subscribe to our Crypto Passive Profits newsletter, and learn all the different ways you can earn passive income in cryptocurrency. All right, let's get back into this. So oftentimes when you're in crypto, you'll see things like APR versus APY. People want to know, what's the difference in APR? What's the difference in APY? How does it work? Let's just come down here and take a look. These are APRs, but if you come over here to pools, you'll see APY. What is the difference? What does it all mean? What affects APR? What affects APY? Where does it come from? First thing, if you don't know where it comes from, first, I'm going to assume you know how to yield farm, or at least you understand the basics. But if you don't, I have a video on how to yield farm. I'll link that above. I'll put it down in the description. That was going to get you caught up to speed. That particular video is talking about yield farming on the Binance Smart Chain in general. But even if you are yield farming on Ethereum or Polygon or any other chain, if you're doing yield farming, that video still is going to explain the overall premise of how it actually works. So with that being said, what is the difference in APY versus APR? Let's come here and take a look. This little paragraph explains it. And I'm going to give you a little tip to help you remember. If interest was compounded annually, then APR and APY would be the exact same number. Whenever interest is compounded more frequently, the APY typically becomes significantly larger than the APR because the interest earns additional interest on itself throughout the year. So another way to think about this is APR is the rate at which you're earning, the real-time rate. APY is what you've earned over the year after all compounding's occurred. If you're having compound, say once a month, then APR is going to be much higher than APY because you're going to be earning interest on top of interest, gains on top of gains. And here's what that looks like in practice. So if you had $10,000, and let's just say that you had a yield farm paying out 10% a month or 120% a year, if you're compounding yearly, your APY would be 120%, so you'd make $12,000 on your $10,000. Your APY, by the way, is still going to be 100. Your APR is still 120%, but your APY is also 120% because you're compounding yearly. You're making 120% on $10,000, which is $12,000. That's your profit for a total of $22,000, and that's your annual earnings. But if you're compounding monthly, then we will take this to monthly. Look at how much higher it is. 213% APY. So let's look at that again. If you were compounding yearly, 230% APY, your APR is still 120. You're still getting 120% interest rate. Basically, another way to think about it is the APR is just a pure interest rate, or the simple interest rate. Yearly, your APY is the same as yearly, 120%. One more time, monthly, just so you can see this. Significant difference in your earnings. Compound interest, compound interest, compound interest, ladies and gentlemen. What does that mean when on the yield farms? Where does it come from? Is it sustainable? Now, when you're yield farming, you can see some really high yields, APRs, APYs. This would look nuts in traditional finance. You come over here to something like Adamant, it looks even crazier. And where does this come from? How is this possible? Is it sustainable? So I'm going to just keep this very simple. In almost every case, this is ApeSwap, this is another one. You get paid out when you're farming in the native token. So assuming you understand how yield farming works, you put in Banana, you put in BNB, they pay you back in the Banana token as an incentive to provide that liquidity here. You can also use things like aggregators, which do this for you, and they even compound it, meaning they take your Banana, they sell it, they add more Banana, more BNB liquidity. All your Banana rewards, they sell the rewards, add more Banana, more BNB. If you use an aggregator like ApeRocket, for example, you get much higher yields because they're doing all that for you. And they're paying you their space token. So you don't just get the Banana token, you also get the space token, which is another native token. And the space token currently has a value in this case of $20. So that's where you get these yields from. That's why they can be so high. A lot of these farms can get quite creative. In fact, one of the more creative I've seen is Adamant Finance. I'm going to be talking about them in another video, but they're creative. And all these are high risk. There's a lot of risk. Now, the strategy, if you wanted to do this in a way that is less risky, although all this stuff is risky, you need to understand you're at risk for, smart contract risk, bad dev, bad project management, project could get abandoned. All this stuff can happen. Stable coins could lose their peg. People don't even realize that's actually a risk, but it is a risk. It's low risk, but it is a risk. So the safest possible way to yield farm is come to a farm that is stable, that that appears like it shouldn't go anywhere. Devs shouldn't run away, and come over and basically farm two stable coins like BUSD and let me see. Right here. True USD is a stable coin, BUSD is a stable coin. Now, you're not making a lot because you're not taking on a lot of risk, but there's a reason why there's $65 million in here versus this one, 354,000. Yeah, the APR is higher, but this is probably extremely risky. So APR is 14.75%. Not very high. What you can do is you can come in here, hold your stable coins in here, and you can sell these profits. Now, most tokens end up looking like this when they launch. Most farm tokens, native tokens, things like Space, Banana, even Pancake and Bunny, all those tokens, they typically go up really high and then they go down. And the extent to which they go down has a lot to do is there a real team, real development, a real vision behind the token, that sort of thing. That has a lot to do with how far and how deep they go down. Sometimes they can, kind of curve back up and start going back up, but they're usually it's hard for them to reach those new all-time highs, although sometimes they do it. But what most people are doing is they're farming the native token and they're selling that token on the market. That's why the price eventually drops. At some point, it stops going up. Big holders will just sell and it dumps. But even if big holders don't dump, you'll kind of see this kind of rounded curve at the top. And the reason the rounded curve occurs is because at the point at which less people are holding than the ones selling, you'll see the price go down. Originally, it starts out, people are optimistic. They'll buy it. They'll hold the token. They'll farm the token. And sometimes people won't sell it because they know it's going up in price and they want to hold it. But at some point, people decide to start taking profits, or the people who are farming, there's a lot of farmers on board now, and everybody's farming that token to earn that yield, and they just keep selling it. And the price goes down, and they're just selling. So one of the safest strategies in all of yield farming is go into all new farms that you trust, because there's always a risk that a farm, like there's a total risk that the devs could just run with funds. That's always a risk. But one thing you can do is go in with stable coins, and then you limit some of your risk. You don't have the same token risk, and then you just sell your stable coins. I can cover that in more depth in another video. The main thing I wanted to cover today is understanding the difference in APR versus APY. And again, a quick recap. APR is the current rate at which a project is paying. APY is including the rate plus all the compounds plus all the additional token payments and or fees that are earned. It's everything combined. It's the yield for the year. That's how you can remember APY. APR is the current earning rate. Hopefully that's been helpful to you. Now I want to cover some more content on the channel. I want to know if you want me to cover high risk DeFi yield farming methods first, or if you want me to cover primarily lower risk methods. Put down in the comments, say high risk degen or low risk more stable. And low risk is a really just lower risk, because in crypto and yield farming, everything's high risk. If you love earning passive income, you love cryptocurrency, and you believe in this technology, do me a favor and smash that like button. Ladies and gentlemen, this is Crypto Wealth. I'm out. By the way, one last thing that I want to make certain that I cover. High APYs or APRs, whatever, don't typically last. You can't count on 5,000% or, 400. In fact, this 475,000%, I'm in this pool. Am I earning good? Yes, but it's primarily because of this Titan token is going up in price. That's the main reason I'm earning good. Am I going to make 475,000% APY? Never. I mean, if you did the math on what that would turn into, it's never going to happen. There's a lot of reasons. There's things called impermanent loss. There's a lot of dynamics at play. But overall, typically when a project is new or more risky, the APYs can be much higher. Over time, whether it's because of an underlying token they're paying out with, say the ADDI token or whatever, collapses in price, then APYs go down, or more people come into the pool, APYs go down. Now, what you can expect is seeing APYs like this. These sort of projects, these sort of APYs and APRs are more in line with what you could see with a longer term project, something that could be a little bit more stable potentially. But if you're in a high risk, if you're yield farming high risk assets, expect them to be risky. That's why I gave the example of stable coins. But still, earning where was it at on stable coins over here? Earning 14%. The bank's not paying you 14%. Now, for me personally, I'm not going to stake two stable coins that earn 14%. I can trade more than that. I mean, my trading earns me about 10% a month, and most of that's passive. So I would rather do 8 to 12%, 15% trading than I would staking stable coins. But not everybody knows how to do that or has that skill set. So just keep that in mind. These high APYs, high APRs will go down over time. That's totally normal. That's totally expected. By the way, did you smash that like button yet? Go ahead and do that. Thank you so much. Till next time.